Trading can often feel like deciphering an unsolvable puzzle, right? But what if I told you there's a tool that allows you to read the market like an open book? Today on Tradecraft, we're unlocking the secrets of candlestick patterns, the timeless technique that professional traders, including myself, have relied on for over a decade to predict market moves and seize opportunities. If you're ready to elevate your trading game and learn how to decode the market's every move, you're in the right place. Stick with me and let's master the market, one candle at a time. Why candlestick patterns matter. Candlestick patterns aren't just colorful bars on a chart. They're a visual representation of the psychology driving market movements. Each candlestick tells a story about the tug-of-war between buyers and sellers in a given time frame. Here's why every trader should understand candlestick patterns. Clarity in chaos. Markets can feel overwhelming, but candlestick charts distill price action into simple, understandable visuals. Predictive power. They reveal potential reversals, continuations, and areas of indecision before they happen. Universal applicability. Whether you trade stocks, forex, or crypto, candlestick patterns work across all markets and timeframes. Before diving into specific patterns, you need to understand the anatomy of a candlestick and what it communicates. Every candlestick consists of three key components. The body, the thicker, rectangular part of the candlestick, represents the range between the opening and closing prices during the selected time frame. Green or white body indicates that the closing price was higher than the opening price. Red or black body indicates that the closing price was lower than the opening price. The wicks or shadows, thin lines extending above or below the body. Upper wick represents the highest price reached during the time frame. Lower wick represents the lowest price reached. The color. This helps quickly identify whether the market closed higher or lower than it opened, adding clarity to market sentiment. What does this mean for you as a trader? Candlesticks aren't just price markers, they're mood rings for the market. By observing the body size, wick length, and color, you can infer whether buyers or sellers had the upper hand. For example, a long wick with a small body suggests indecision or a potential reversal. A large body with short wicks shows strong momentum in one direction. Now that you know what a candlestick represents, we'll explore how patterns formed by multiple candlesticks reveal critical insights. Bullish patterns, perfect for spotting buying opportunities after downtrends. Bearish patterns help identify when to exit or short sell after uptrends. Continuation patterns signal pauses in trends, allowing traders to plan their next move. Candlestick patterns are a powerful tool, but remember, they work best when combined with other forms of technical analysis, like moving averages, volume, or support and resistance levels. All right, now that you know the basics of candlesticks, let's talk about bullish candlestick patterns. These are your green lights, the signals that say it's time to buy. Bullish patterns typically appear after a downtrend, indicating that sellers are losing steam and buyers are stepping in. Recognizing these patterns can help you enter trades at just the right moment to maximize profits. Let's break down 6 of the most effective bullish patterns. The hammer is a classic bullish reversal pattern, and it's easy to spot once you know what to look for. Appearance: small body at the top of the candlestick. Long lower wick, typically at least twice the size of the body. Little to no upper wick. What it means: the hammer forms at the bottom of a downtrend, signaling that sellers dominated early in the session, but buyers fought back to close near the opening price. This suggests that the selling pressure is waning and buyers may soon take control. Trading tip: a green hammer is stronger than a red one because it shows more bullish momentum. However, always confirm the signal with additional indicators or the next candle's movement. This is like the hammer but flipped upside down. Appearance: small body at the bottom of the candlestick. Long upper wick, often twice the size of the body. Little to no lower wick. What it means? The inverted hammer suggests that buyers tried to push prices higher during the session, but couldn't maintain momentum. However, it's still a bullish signal because it indicates sellers are losing dominance. Trading tip: the inverted hammer often requires confirmation from the next candle. Look for a strong green candlestick, following it to confirm the reversal. This is one of the strongest bullish reversal patterns and consists of two candles. Appearance: first candle, a small red body. Second candle, a large green body that completely engulfs the first candle. What it means: the first candle shows bearish sentiment, but the second candle represents a strong shift as buyers take control and push prices significantly higher. Trading tip: volume is key here. A bullish engulfing pattern with high volume adds more weight to the signal. This is a two-candle pattern that signals a strong reversal. Appearance: first candle, a long red body. Second candle, a long green body that opens below the previous candle's close, but closes above its midpoint. What it means: the gap down at the open of the second candle initially suggests bearish control, but buyers step in and push prices higher, signaling a potential reversal. Trading tip: look for this pattern near significant support levels for better accuracy. The morning star is a three-candle pattern that indicates hope in a bearish market. Appearance: first candle, a long red body. Second candle, a short body, either red or green, showing market indecision. Third candle, a long green body that closes near or above the midpoint of the first candle. What it means: the first candle shows strong selling pressure, but the second candle indicates indecision. The third candle confirms a reversal as buyers regain control. Trading tip: combine this pattern with RSI or MACD divergence for a stronger confirmation. This is a powerful bullish continuation pattern that suggests strong buyer momentum. Appearance: three consecutive green candles. Each candle has a small wick and closes higher than the previous one. What it means: this pattern appears after a downtrend or period of consolidation, showing that buyers are steadily gaining strength. Trading tip: ensure the candles are not overly large or accompanied by high wicks, as that could indicate exhaustion. Now that you know these 6 bullish patterns, you might be wondering, how do you use them in your trading? The key is context. These patterns work best when combined with other tools, like support and resistance levels or moving averages. For example, if you see a hammer pattern forming at a major support zone, that's a high probability setup you shouldn't ignore. Just like bullish patterns signal opportunities to ride the wave upward, bearish candlestick patterns are your early warnings that the market may be headed south. Whether you're looking to exit a trade, lock in profits, or even profit from the downside by shorting, these patterns are invaluable tools. Let's explore 6 key bearish candlestick patterns that can help you stay ahead of the market's moves. The hanging man is essentially the bearish counterpart to the hammer. Appearance: small body at the top of the candlestick, long lower wick, at least twice the length of the body, little to no upper wick. What it means: the hanging man forms at the top of an uptrend and signals that sellers are beginning to overpower buyers. Although the price was pushed higher during the session, strong selling pressure brought it back down. Trading tip: wait for confirmation, such as a red candlestick following the hanging man, to ensure the reversal is underway. The shooting star is another bearish reversal pattern, similar in shape to the inverted hammer, but forms after an uptrend. Appearance: small body near the lower end of the candlestick, long upper wick at least twice the size of the body, little to no lower wick. What it means: the shooting star indicates that buyers attempted to push prices higher, but were met with strong selling pressure, driving the price back down near the opening level. Trading tip: this pattern is stronger when it forms at a major resistance level or when volume spikes during the session. A bearish engulfing pattern is one of the most reliable signals of a potential market reversal. Appearance: first candle, a small green body. Second candle, a large red body that completely engulfs the first candle. What it means: the small green candle shows that buyers were in control briefly, but the larger red candle reveals a surge of selling pressure, reversing the uptrend. Trading tip: look for high volume on the red candle to confirm the strength of the bearish signal. The evening star is a powerful 3-candle pattern that signals a bearish reversal. Appearance: first candle, a long green body. Second candle, a small body, either red or green, indicating indecision. Third candle, a long red body that closes near or below the midpoint of the first candle. What it means? The evening star shows a transition from bullish momentum to bearish control. The first candle reflects strong buying, but the second candle signals hesitation. The third candle confirms the reversal. Trading tip. The pattern is strongest when the third candle's close erases most or all of the gains from the first candle. This pattern signals the start of a strong bearish trend. Appearance. 3 consecutive red candles. Each candle has a small wick and closes lower than the previous one. What it means? The 3 black crows pattern appears after an uptrend or consolidation, showing sustained selling pressure. Sellers have clearly gained the upper hand, and prices are likely to continue falling. Trading tip. Be cautious if the candles are overly large or have long wicks, as this could indicate overselling or temporary exhaustion. This pattern resembles the bearish counterpart to the piercing line. Appearance. First candle, a long green body. Second candle, a red body that opens above the previous candle's close, but closes below its midpoint. What it means? The gap up at the start of the second candle suggests bullish momentum, but the strong red close shows sellers taking over. This indicates a bearish reversal. Trading tip. If the red candle's close is significantly below the midpoint of the green candle, it adds more strength to the bearish signal. How to use bearish patterns effectively. Bearish patterns are your early warnings to prepare for downward movement, but they're even more powerful when combined with other analysis tools. For example, a bearish engulfing pattern forming at a key resistance level or during an overbought RSI condition is much more reliable. Always consider the broader market context and confirm your signals. Imagine you're trading a stock that's been on a steady uptrend, and you suddenly spot a shooting star at a significant resistance level. This is your chance to either exit the trade and lock in profits or prepare for a short position. Combine this with confirmation from the next candle, and you've just made an informed decision based on a reliable signal. Not all candlestick patterns signal a reversal. Some of the most useful patterns for traders, especially in trending markets, indicate that the trend is likely to continue after a brief pause or consolidation. These are known as continuation patterns. If you're trading in a market that's already trending strongly, these patterns can help you identify the best times to stay in the trade or even add to your position. The doji candlestick is one of the most widely recognized continuation patterns, yet it can also signal indecision, so understanding its context is crucial. Appearance. A small body with long upper and lower wicks. The open and close are nearly the same price. What it means? The doji represents a struggle between buyers and sellers, with neither side taking control during the trading session. When it appears in the middle of a trend, the doji often signals indecision, which typically leads to a continuation of the prevailing trend. Trading tip. A doji in a strong uptrend is often seen as a brief consolidation before the trend resumes upward, while a doji in a downtrend may suggest that selling pressure is waning and a continuation to the downside could follow. Look for confirmation in subsequent candles. The spinning top is another neutral pattern that typically signals indecision. However, when it forms in a strong trend, it often indicates a short pause before the trend resumes. Appearance. Small body centered between 2 longer wicks of equal length. What it means? The spinning top shows that the market is in a state of indecision, as neither the bulls nor the bears were able to maintain control for the entire trading session. In a strong trend, the market will often consolidate with spinning tops before continuing in the direction of the original trend. Trading tip. A spinning top after a strong price movement, either up or down, is often a sign of consolidation, so it's best to stay with the trend. Look for the next candle to confirm the direction of the trend. This pattern is a strong indicator that a trend is likely to continue in the same direction, particularly in an uptrend. Appearance. A large green candle is followed by 3 smaller red candles that stay within the range of the first candle. The final candle is another large green candle, confirming the resumption of the uptrend. What it means? The rising three methods pattern shows that the uptrend is intact, despite some short-term selling pressure. The market is consolidating in a narrow range before continuing higher, driven by strong buying momentum. Trading tip. This pattern works best in a strong bull market. Wait for the final candle to break the high of the first candle before entering a long position. Just like the rising three methods pattern signals the continuation of an uptrend, the falling three methods signals the continuation of a downtrend. Appearance. A large red candle is followed by three smaller green candles that stay within the range of the first red candle. The final candle is another large red candle, confirming the continuation of the bearish trend. What it means? The falling three methods pattern shows that, despite a short-term pause or consolidation with minor buying pressure, the overall downtrend remains intact. It indicates that the sellers are in control and are ready to push prices lower once again. Trading tip. Similar to the rising three methods, the falling three methods is most effective when identified in a strong bear market. Wait for the final red candle to break the low of the first candle to enter a short position. Both pennants and flags are continuation patterns that form after a sharp price movement, often in the middle of a strong trend. Appearance. Flag. A rectangular shape that slopes against the prevailing trend, followed by a sharp price move in the same direction as the previous trend. Pennant. A small symmetrical triangle that forms after a sharp price move. The price consolidates within the triangle, then breaks out in the direction of the previous trend. What it means? Flags and pennants are short-term consolidation patterns that signal that the trend is likely to continue once the price breaks out of the pattern. These patterns often form after a strong move and indicate that the market is taking a short breather before resuming the trend. Trading tip. Watch for a breakout from the flag or pennant to confirm that the trend is resuming. A flag forms in a strong uptrend or downtrend, while a pennant forms in any direction. The triangle pattern is another continuation pattern that signals consolidation within a trend before the price breaks out in the direction of the overall trend. Appearance. Symmetrical triangle. Two trend lines converging toward each other, creating a triangle. Ascending triangle. A flat upper trend line with an upward sloping lower trend line. Descending triangle. A flat lower trend line with a downward sloping upper trend line. What it means? Triangles form as the market consolidates, with the range of price narrowing as time goes on. The market is indecisive, but once the price breaks out of the triangle, it typically resumes the original trend. Trading tip. Wait for a confirmed breakout above or below the triangle's boundary. Symmetrical triangles signal a balanced struggle between bulls and bears, while ascending and descending triangles indicate that one side, either buyers or sellers, are gaining control. By now, you've learned how to identify both reversal and continuation candlestick patterns. But knowing how to spot these patterns is only part of the equation. To successfully navigate the markets, you need a strategy that combines candlestick analysis with other technical tools, so you can make informed, confident decisions. In this final part, we're going to tie everything together and show you how to use candlestick patterns in your overall trading strategy. We'll also discuss how to manage risk effectively and improve your overall trading success. Before you even begin to look for candlestick patterns, you need to identify the current market trend. Trend analysis is the foundation of any solid trading strategy because it gives you the broader context in which to interpret candlestick patterns. Use trend lines, moving averages, or even the Relative Strength Index, RSI, to help you determine whether the market is trending up, down, or consolidating sideways. A clear trend makes it easier to spot patterns that are more likely to be successful. For example, a bullish reversal pattern like the morning star is most reliable when the market has been in a strong downtrend. In contrast, a continuation pattern like the rising three methods works best in a strong uptrend. A simple moving average or exponential moving average can help you confirm the direction of the trend. When the price is above the moving average, the market is generally in an uptrend. When it's below, it's a downtrend. You can use this to filter out trades that don't align with the overall market direction. Candlestick patterns that appear in the direction of the trend are more reliable. For instance, if you're in an uptrend, a bullish candlestick pattern, like the bullish engulfing or three white soldiers, is a sign to potentially enter a long position. On the flip side, in a downtrend, a bearish engulfing or shooting star might signal that it's time to look for short opportunities. Support and resistance levels are crucial in any technical analysis, and they work hand in hand with candlestick patterns to confirm entry and exit points. Support levels are price levels where an asset has repeatedly bounced upward, while resistance levels are price levels where the asset has previously been unable to break through and has fallen back down. These levels act as psychological barriers, and when price approaches these levels, it's an important point to watch for candlestick patterns. A candlestick pattern forming near a significant support level could signal a reversal. For example, if you see a bullish engulfing pattern near a strong support level, it's a sign that the buying pressure may be taking control. Similarly, a pattern like the bearish engulfing near a resistance level could indicate that the market is about to reverse to the downside. Confirmation. Use candlestick patterns as confirmation for entries and exits around these key levels. If a candlestick pattern forms near support and price bounces back up, that's your confirmation to go long. Likewise, if a pattern forms at resistance and price begins to reverse, you may consider going short. Volume plays an essential role in confirming the strength of a candlestick pattern. The more volume, the more likely it is that the pattern represents a true shift in market sentiment. A candlestick pattern accompanied by high volume suggests strong market participation and indicates that the pattern is more likely to lead to a real market move. For instance, a bullish engulfing pattern formed on high volume can signal a stronger potential for an upward move. Conversely, a bearish engulfing pattern accompanied by high volume signals that the market is likely to see further downside movement as selling pressure is increasing. If a pattern forms with weak volume, you might want to be more cautious as it suggests a lack of conviction behind the price movement. In continuation patterns like the rising three methods or the ascending triangle, high volume is crucial for confirming the breakout. If the breakout occurs with high volume, it increases the probability that the trend will continue. Now that you know how to combine candlestick patterns with other technical indicators, it's time to talk about risk management. This is where many traders fall short, but it's essential to your long-term success. A stop loss is a tool that automatically closes your trade when the market moves against you by a set amount. It's a safety net that ensures you don't lose more than you're willing to risk. For example, after entering a trade based on a bullish reversal pattern like a hammer, you can place a stop loss just below the low of the hammer to protect against any unexpected downside movement. One of the most important principles in trading is ensuring that your potential reward outweighs your risk. A common risk-to-reward ratio is 1-to-3, meaning that for every dollar you risk, you aim to make $3 in profit. If the stop loss for a trade is 50 pips, you would want to aim for a target profit of 150 pips or more. This helps to ensure that your profits will be significantly greater than your losses over time. Another important part of risk management is position sizing. This involves determining how much capital you'll allocate to each trade based on your total account size and risk tolerance. Never risk more than 1-2% of your account balance on any single trade. Now that you understand how to incorporate candlestick patterns with trend analysis, support and resistance, volume, and risk management, it's time to put it all together in a trading strategy. A well-thought-out trading plan is essential. It should include what markets you'll trade, which candlestick patterns you'll look for, how you'll incorporate other technical indicators, the amount of risk you're willing to take per trade, your profit targets and stop-loss levels. Once you've developed your strategy, it's time to test it. Backtest your strategy by reviewing historical price data and seeing how your candlestick patterns would have performed in past market conditions. This helps you understand how your strategy works in various market conditions and refine it for better results. If you're new to trading or testing a new strategy, use a demo account to practice without risking real money. This allows you to get comfortable with executing trades and understanding how your strategy plays out in live conditions. Mastering candlestick patterns is just one piece of the puzzle in becoming a successful trader. By combining them with trend analysis, support and resistance levels, volume, and solid risk management, you can dramatically improve your trading decisions and increase your chances of long-term success. Keep in mind, trading is not about catching every single move. It's about being patient, disciplined, and making well-informed decisions based on the tools at your disposal. Now that you have the tools to spot candlestick patterns, combine them with technical analysis, and manage risk, it's time to put everything into practice. Keep learning, keep refining your strategy, and most importantly, stay disciplined. Good luck out there, and don't forget to subscribe to Tradecraft for more tips and strategies that can help you become a master of the market, one candle at a time.